Hello, Culture Matters podcast. Boy, am I excited about this episode. Here's a quote: Freedom is not procured by a full enjoyment of what is desired, but by controlling the desire. Epictetus.
Hmm.
Our guest today, you may not have heard of him because you don't listen to podcasts, or you might just skip by because you listened once and didn't like it. But I like it. Bill Mervin is a mortgage marketing, I say mortgage marketing, mortgage expert, an advisor, a debt and wealth creator. And today we're going to talk about debt, equity, expectations, wealth building. Bill's been helping people for basically out of the womb. But in the last 20 years or so, as it relates to home buying process and it's more than that. There's a there's a there's a planning element. We'll talk about that today. Thanks for coming back to the show.
Always a pleasure, Jay. Happy to be here.
I first thing I'd like to know is in whose right mind does it make sense to give someone the ability to essentially mirror the bank. And what I mean by that is I read these conspiratorial Jekyll Isle books about banks being able to lend out 9 or 10 times more than they keep on hand. And then I come to find out that when we're buying a home, it seems like consumers are able to do something similar to be lent many greater times more their than they have on hand. So I guess I'm not sure if there's even a question in that. Is what I'm saying even true?
I don't
Or
think it's true, actually,
yeah, help
because
me out here.
I think the issue with fractional reserve banking is that they lend it out, but then, I don't, well, I mean, I suppose there's certain capital controls in place with the larger banks, but, I think some of the problems that it's gotten into is that, you know, with some of the financial wizardry that's gone on, certainly of recent times, they don't necessarily have the assets, right? It's not really backed by the assets. So it's all, there's all sorts of ways that, banks can, show assets on the book, and those assets may not be liquid, right? And then, there's a big thing with this whole, thing with the interest rates is the issues that it's masking a lot of the balance sheet issues, a lot of the banks, because, everybody, all these banks own treasuries. The treasuries, have taken a walloping, right? So in the case of the banks, it's the assets that they have on hand, right, that are then allowing them to loan out at certain multiples. But with some of the accounting tricks that go on, so for example, I would imagine many of the people listening understand this, but many may not. So, if you buy a 10-year treasury bill, bond, and you keep it for 10 years, then you'll get your whole principal back. And so therefore, many of these banks don't necessarily mark down. But in the interim, right, as yields go up and down, the price that you would be able to sell that in the market changes, right? If I have a 4% bond and current interest rates are 6%, right? I'm not going to pay you the full face value of that bond for your 4% interest rate when I can go out and get a 6% interest rate. So the price, which moves inverse of yields, is now less, right? But because in theory you could hold that bond for 10 years and you would get the face value back, these banks oftentimes don't mark down the value of that asset. But in reality, when you've had a huge run up in interest rates, the current value, the market value of that asset is significantly less. So that's an example where, in theory, these banks list the whole face value of that bond on their balance sheet, which allows them to lend at a certain multiple of that amount. But in the reality of the marketplace, if they had to liquidate, it would not be worth nearly as much. When you own the real estate, it's real property, right? And so I feel like, it's certainly, I mean, you can make an argument about declining real estate prices, but in theory, it's backed by a real asset, and there's no really kind of a financial accounting or wizardry that can go on to change that leverage that was loaned on it. So I feel that loaning against real estate, even though there's a lot more leverage today than there used to be, is a heck of a lot more secure than what banks are doing.
Do you think that people have a bit too much freedom as it relates to their ability to choose what they borrow? But I know that seems like an oxymoronic question to ask someone that leans in your ideologies, but maybe there's another way I could phrase that. Like, why are we able to borrow so much relative to what could be some of the reasons why we'd be able to borrow so much relative to our earning power? What are some of the pros to that?
Yeah, I mean, I have to actually take a stab at your first question just because it was
Please.
I'm like, are we going to get into a more philosophical discussion here or not? So,
And you may help this make sense for the listener too, because I
yeah.
don't think I'm doing a good job setting the stage.
Well, as it relates to do they think people have too much freedom, the answer to that for me is almost always no, right? I believe in buyer beware. I believe in people being able to make bad choices and having the freedom to make bad choices, right? And then
We'll just take that clip for the marketing people.
and then deal with the consequences of their poor choices. And I don't think that they need a nanny state or a bunch of regulators telling them what they can and can't do. So that's just my thoughts on that. Now, not as a commercial for what we do, but I think that that's why there's got to be good players in the industry who are helping people make wise choices, right? One of my big things that I always tell folks is I'm not here just to tell you what you can do. I'm helping you understand what you should do or what you're comfortable doing and making sure that you're armed with the information necessary to make wise choices about it, right? And why can people borrow such a large percentage of is it their income or
Well, first we should probably answer for the audience, what can people usually borrow? If they're going to buy a home, for example, what can people borrow? How does that usually work? Debt to income, those types of things?
Yeah,
That all depend on their credit as
not
well as, or their blanket, like, all right, this is how much everybody could borrow this much
yeah,
percentage wise.
loosely, the maximum debt ratio that you can borrow. So a debt ratio, to slow it down, is the percentage of your monthly liabilities as a percentage of your gross monthly income, or qualifying gross monthly income, I could say. Sometimes people have income that can't be used, right? You got, bonus or commission income you've earned for less than 12 months, or you've got overtime income that's unstable and comes and goes, and so therefore it's not stable and not usable, which consequentially, in its purest form, is why I think sometimes that the allowable debt ratios are so high, because there's a recognition that there may be income there that's not currently being accounted for. But broadly speaking, on a conventional loan, you can borrow 50%. And then monthly liabilities is not like, monthly liabilities isn't, food and things like that. It's just stuff that would show up in your credit report. So car loans and car leases, personal loans, credit cards, student loans, and then, of course, the proposed mortgage. On a conventional loan, in theory, and in most cases, you can borrow up to 50%, right? So I make $10,000 a month in gross monthly income. Those other expenses could come up to $5,000. On an FHA loan, the limit is 57%. And so literally you could have 10,000 a month in gross income before taxes, and then borrow and have 5,700 a month in monthly liabilities. That doesn't include food, that doesn't include cell phone, that doesn't include utilities and all of those things. Now there are some, I don't think that there's a lot of benefit in drawing too down into the weeds of how mortgages work. There are some times where you can't go to that limit. There's something called an automated underwriting system that analyzes the overall risk of the loan. And if all of the factors are marginal, or if many factors are marginal, then there's sometimes that the system may not allow you to get an approval up to the maximum, right? But those situations are less common than they are common. So that's kind of that. Now, for the folks, making 120 grand, making 10,000 hours a month, and even if they've got modest, they got one car payment, maybe not two, and maybe some small credit card balances or some student loans, and so maybe you got 800 or 900 hours a month in liabilities. You could literally max out your debt ratio and have like a 3,500 or 4,000 hour mortgage payment. And in today's market, that's not hard to do. Now, those things, we've talked about this recently, they extrapolate out, right? So if you got somebody making 40 grand a month, they're very rarely going to run their liabilities up to $16,000 a month, plus. Although in theory, they could do that. So that's kind of how the leverage works in terms of how much you can borrow for your income. Now, oftentimes, where you see it most, although again, I just gave you an example where it may be the true debt ratio, and people, to buy a 450,000 hour house with 8 grand in taxes, they may, and not even loaded up on debt, they may be close to that limit. A lot of times it may be that you got one spouse that's got a better credit score than the other. So there's other income coming into the home that's not being counted, or things like that. So there are times where, you could stretch it up to the limit, and this underlying situation is not as bad as what it might appear on paper. But these days it's not uncommon for quote unquote middle America to approach those maximums.
And you said conventional is 50%,
Yeah.
and that's with all those other fixed liabilities.
Yeah.
Would you consider them personal fixed liabilities, like analogous to like if a business has fixed costs, like
Well,
rent,
I guess, I
or not
mean,
rent?
just most specifically, it's liabilities predominantly. There can be some exceptions like child support, or if there is a recurring liability on your bank statement that gets caught by the underwriter, like, hey, here's 250 a month that comes out every month. Maybe it's a personal loan, a personal note that you sign with somebody. So there could be questions on that. But predominantly it's stuff that would be on your credit report, right? So like I say, that's going to be a car loan, a car lease, student loans, credit card debt. Maybe I took out one of these personal loans to consolidate some credit cards or something, although those aren't usually too great. But it's not all of the stuff to live. Yeah, it's not food. You could argue that a phone bill is monthly, right? That might be a fixed expense, but that doesn't get counted against you, right? Or utility bill, things like that. So it's really extended credit, more so than it is fixed monthly life. Fixed or variable is less important than whether it's like extended credit, either a revolving debt or a installment debt. Installment would be your car note. Installment debt would be your student loans. Revolving would be credit card, home equity line of credit, et cetera.
If someone, borrows up to, 90% or greater of that 50%, what's the likelihood that they'll end up saving any money and investing in the future outside of the home?
Well, I'm glad that you made that key point, outside of the home, because, you know, uh,
And can we
better.
use an example? Like, let's say 10,000 comes in a month, 5,000 is gonna be the max, right? Of the mortgage and the other stuff you mentioned, like credit cards and all those kinds of things.
Well, let's face it, with 10,000 a month in
And is that
income,
before tax or after
that's
tax? What
before
does that
tax,
mean?
man. So, I was gonna say, with 10,000 a month in income, if you're lucky, right? If
What
you're
do we
lucky,
keep?
you're left with 7,500 or 8 grand. And that's if you're lucky, right? By the time um big our big brother gets their hand out of our pocket. So you might be left with 2,500, you know, 2,000 to 3,000. So we'll call it $2,500, right? That's not including contribution to healthcare. It's not including, all your utilities. It's not including, car maintenance. It's not including house maintenance. It's not including, a lot, food. So it could be challenging. Now, I would say for some folks, the mortgage is the greatest accumulator of wealth. I know our good friend, the 10X guy, would say otherwise, but for most folks, I mean, so for example, if I've got a $400,000 mortgage, and in the early years, you might have 4,000 a year, 5,000 a year of that mortgage payment going towards the principal, right? And I mean, that's called principal reduction, right? So if I've got a $3,500 mortgage payment, maybe 400 a month of that is going to reduce the balance of my loan. If it's going to reduce the balance of my loan, it's going to increase my net worth, right? Net worth is assets minus liabilities, right? So if my liabilities is going down, that's increasing my net worth. As that loan balance is paid down, then the amount that's going towards the principal is going to increase. So it's like an ever increasing forced savings plan, if you will. If that $450,000 loan and I $400,000 loan, I got a $450,000 property. I mean, you got a pretty good track record over the last 100 years of 3-4% appreciation in real estate, right? A few people will point out a few anomalies, but other than the Great Depression and the real estate / financial collapse, which was a very isolated incident, right? And we could look at what was going on during that time and whether those conditions are still here. But real estate can be relied on, I think, other than hyper local types of scenarios, as a 3-4% appreciation. So let's take the lower end of that and say 3% appreciation. On a $450,000 house, that means on average, using conservative estimates of appreciation, over time, you're getting $14,000 of capital appreciation, right? So that's $1,200 a month, right? And 3% on 500 is more than 3% on 450. So similar to the principal reduction, the appreciation that you're realizing, even if the rates stay the same, is going to grow over time as the asset grows, right? So if we have a $3,500 mortgage payment, by those assumptions, about $1,600 of that $3,500 is flowing back into the borrower's balance sheet, right? And what I call like a forced savings plan. So yeah, for a lot of folks, that's what they can do, and that's a lot more than they're going to be able to save on their own without the leverage of owning real estate, right? And then there's all sorts of benefits we could get into of the stability of families and homes when you own the home versus renting, right? And what that does for a lot of folks. And then, of course, there's the predictability of it compared to the unpredictability of, what your landlord might do in terms of your rent. So if it's the only game in town for you, and this does make it so that you're not allowed to do a ton of extra savings, there is still ample benefit for a lot of folks, cumulatively in owning a home. But hopefully income increases. Hopefully, and certainly in this environment, the mortgage payment will decrease as refinance opportunities present themselves. And so those benefits will just be amplified at that time. And then hopefully there's some money to go around to do some additional saving and investment.
If you're listening to this episode, please share this with a friend that's either dogmatically giving all their money to 10X, or maybe they want to buy a home, or maybe they find these conversations interesting. Please leave a review on the Culture Matters podcast. Bill, what's your word for 24?
Soaring 24. A lot of people in the business are saying survive till 25, but I saw this great, I'm not going to quote it, this great thing today. Geez, what was it? Well, just talking about that, market can, it's really a mindset game, right? At the end of the day, if you believe you're going to thrive, you will. And so that's just the thing, is just trying to not buy into the doom and gloom, and stay positive.
Please share this episode. Please leave us a review. We'll see you next time on the Culture Matters podcast.